I want you to imagine a market of tension, where every headline, regulation shift, and liquidation ripples through the minds of traders, institutions, and ecosystem builders alike. Over the last several days, the crypto world has been living that, a storm of volatility, uncertainty, and opportunity. This is where narratives are born or die. We begin with the carnage. In late September 2025, cryptos faced one of the most brutal drawdowns in memory. Reports suggest more than $160 billion in value was erased in a matter of days, mainly through forced liquidations of leveraged positions. The derivatives markets cracked. Over $1.7 billion in futures longs were liquidated, taking down Bitcoin, Ethereum, XRP, Solana, and many altcoins in the cascade. The emotional shock of Red September left most traders shaken. Bitcoin fell over 2%, slipping beneath $110,000, as analysts scrambled to reassess support levels and risk zones. Ethereum, Solana, and XRP felt even steeper pain in percentage terms. The scene was chaos, and in chaos, clarity tries to emerge. As the dust settled, some recovery snuck in. Optimism returned as Bitcoin bounced toward $114,000. Ethereum regained footing above $4,200, and markets overall showed signs of stabilization. A rally in the gold markets helped broaden sentiment, while political noise in the U.S., especially around potential government shutdowns, added fuel to the narrative of crypto as alternative value. The dynamic is complex. The macro, regulatory, and technical forces are all colliding. One of the most consequential developments right now is on the regulatory front. In the U.S., the SEC and CFTC are coordinating more closely. A joint roundtable was scheduled to discuss unifying oversight across digital assets. At the same time, regulatory leaders have floated ideas of cross-border crypto passporting, especially between the US and UK, to streamline compliance regimes for global firms. In parallel, we're witnessing institutional infrastructure expansion. Morgan Stanley announced plans to enable crypto trading on its E-Trade platform via a partnership with Zero Hash, targeting Bitcoin, Ethereum, and Solana for 2026 launch. That's a signal. Mainstream finance is leaning in. In another watershed move, Grayscale obtained approval for a new U.S. multi-asset crypto ETF, incorporating Bitcoin, Ethereum, XRP, Solana, and ADA. That's a structural shift. Altcoins beyond BTC and ETH are now included in core institutional baskets. Meanwhile, globally, innovation is underway in payments rails. China launched an offshore yuan-linked stablecoin, AXINH, in Kazakhstan to boost cross-border trade and further its domestic yuan internationalization ambitions. 9 European banks formed a consortium to issue a euro stablecoin under EU regulation. And governments from Pakistan to the UAE are building crypto councils and compliance regimes. In 2025, Pakistan instituted the Pakistan Crypto Council, tying regulation, adoption, and policy into a central framework. Under these converging pressures, individual protocols must either adapt or fade. Let's walk through the 6 major cryptos: Bitcoin, Ethereum, XRP, Solana, Dogecoin, Cardano, not as isolated bets, but as actors in a system mid-reboot. Bitcoin, of course, is the anchor. It bore the brunt initially when leveraged longs were squeezed. But it also is the reference point, the benchmark. Because the recent ETF reforms and institutional access depend on Bitcoin's legitimacy. What's striking now is that Bitcoin is closing in on critical monthly and quarterly settlement windows. The next 48 hours could determine whether it holds major support around $105,000 or capitulates further. If buyers step in, the path toward $117,500 or more becomes credible. If not, we may revisit zones under $100,000. Bitcoin's price action will define much of the market psychology in the coming cycle. But Bitcoin is not just price, it's network evolution. Advances in the Lightning Network have recently been formalized via verification proofs. ensuring funds are safer in all scenarios under all paths. That matters when Bitcoin is touted as both a store of value and a payment backbone. Security, reliability, and layer 2 scaling are no longer optional. Ethereum is under heavier pressure, but also under transformation. Its fee revenue has been under stress as competition and gas declines bite. But deep in labs, researchers propose hardware acceleration, the so-called EVMX, an FPGA-based execution engine that can cut smart contract execution time by 61 to 99%. It's an invitation for ETH and other EVM-compatible networks to scale out dramatically. Beyond that, formal analyses of transaction conflicts in Ethereum versus Solana show that Ethereum historically has higher block independence and fewer conflict chains. That gives Ethereum more headroom to scale via parallel execution layers. The tension is this: Ethereum must reconcile between being the settlement hub and seeding innovation to more experimental chains. If ETH can maintain its centrality in rollups, zero-knowledge layers, and cross-chain interoperability, it could retain dominance even under pressure. XRP is in many ways the sleeper plot twist. It was hit in the crash, but now it's benefiting from ETF rotations. Institutional sentiment is turning bearish on BTC, bullish on XRP and Solana. Because of that shift, many believe that funds leaving Bitcoin might find refuge in XRP's regulatory clarity and banking use cases. With the new multi-asset ETF including XRP, institutional access is no longer speculative, it's real. That could unlock a wave of capital rotation from BTC into XRP. Of course, regulatory tail risks remain. In certain jurisdictions, policy uncertainty can drag XRP's momentum. But structurally, XRP's role in cross-border rails gives it asymmetric upside if adoption continues. Solana is the high beta engine of this cycle. It took heavy damage during the liquidation wave, but it's showing resilience. In ETF inflow metrics, Solana and XRP stayed green, while Bitcoin and Ethereum saw outflows. If Solana can regain network stability, throughput reliability, and deliver improved congestion control, it stands to win. The inclusion of SOL in the Grayscale ETF is a signal that institutional frameworks are embracing it, not just the memecoin crowd. Resistance near $117,000 strengthened in BTC. But for SOL, key zones around $210 to $220 will test whether it can break into next leg territory. Should it do so, $260 plus becomes possible. Dogecoin has always danced on the edge of narrative and meme. In crashes, it typically bleeds more. On rallies, it often leads in percentage moves, a leverage proxy for market sentiment. It didn't escape the downturn, but as capital rotates, Doge often benefits secondarily as retail and speculative flows chase momentum. Its challenge remains. Can it transition from joke to tool? Absent stronger utility, Doge will move as a barometer more than a bet. Cardano is the long-term sleeper. ADA is an accumulation by whales, even during corrections, which signals some conviction. Its roadmap towards sidechains, interoperability, and scalability, if executed, could shift it from a research project into real-world infra. Yet execution has been slow, and stakeholder concentration is under scrutiny. But if ADA becomes a serious bridge, chain, or identity/DeFi anchor in emerging markets, its long-term upside takes shape. In a bullish cycle, ADA may surprise if it escapes the promise mode trap. Together, these chains form a web. BTC anchors value, ETH powers smart logic, XRP moves money, SOL scales aggressively, Doge adds social momentum, ADA bridges ambition to execution. The next market regime depends on several pivot forces. First, capital rotation. In prior cycles, Bitcoin and Ethereum soaked up flows. Now, with ETF inclusion broadening to altcoins, rotation into SOL, XRP, ADA becomes plausible earlier in the cycle. The question: who participates and when? Second, stablecoins and rails. The lines between crypto and payments are blurring. The Chinese yuan stablecoin offshore, euro stablecoin initiatives in Europe, institutional bets in Tether's capital raises. All of these are shifting stablecoins from peripheral utilities to foundational plumbing. As governments and banks issue stablecoins, crypto assets become integrated with fiat systems more tightly. Third, regulation as framework, not obstacle. The U.S. regulatory pivot toward crypto modernization, the passporting dialogues, cross-jurisdictional coordination. These are efforts to bring clarity. But missteps or overreach could fracture ecosystems. The protocols that best navigate policy risk will build durable advantage. Fourth, macro, rates, and geopolitical storms. Inflation, central bank pivots, FX pressures, they don't shut off because crypto exists. The interplay between risk assets and macro regimes will define cyclic amplitude. Crypto is still downstream of those currents. Fifth, narrative and execution. In calm periods, what matters is not hype, but delivery. Protocols that build real adoption, resilience, interoperability, developer engagement, they become structural winners. The rest fade as distractions. So where do we go from here? If Bitcoin can hold and reclaim momentum, more capital will flow into underlying assets like Ethereum, Solana, XRP, ADA. The multi-asset ETF is a big unlock. It shifts altcoins from spec plays to institutional assets. If macro and regulatory winds stay favorable, we could see an October or later November charge. If the next 48 hours see a clean monthly and quarterly close, that may trigger a chain reaction of allocations. But if support breaks, especially around $105,000 of BTC, the risk is capital fleeing to safety, dragging the entire market down. The safe plays in that scenario become stablecoins, hedges, or short instruments. As we watch the next few sunrise sessions, don't get anchored to single price moves. Watch the flow, ETF filings, wallet flows, on-chain activity, regulatory filings, capital rotating between assets. That's where the real story is being written. In the volatility, patience is your edge. Don't chase every bounce or collapse. Rather, observe which narratives are gaining consistency through adoption, capital, and regulation. Because the next leg will favor those that earn credibility through disruption, not those that rely on noise. Stay sharp, stay adaptable, and remember, in these moments, cycles aren't repeated, they're refactored.